Good day, students. This is Professor Alexander Buchholz coming to you for Chapter 8, Audit Planning and Materiality. Today, our learning objectives in this chapter are 8 in total. The first is to discuss why adequate audit planning is essential. Second, to make client acceptance decisions and perform initial audit planning. Gain an understanding of the client's business and industry. Perform preliminary analytical procedures. Apply the concept of materiality to the audit. Make a preliminary judgment about what amounts to consider material. Determine performance materiality during the audit planning. Use materiality to evaluate the audit findings. Objective 8.1. Discuss why audit planning is essential. So again, as an auditor, and doing this for quite a number of years, planning is something which you need to be doing, believe it or not, year round. It doesn't occur once, it occurs year round, because by doing an audit and planning the audit, you will be in a position to have an audit done effectively and efficiently. An audit that is not properly planned, and believe it or not, you will see many audits that are not perfectly planned, lead to a rush at the end, lead to people missing things, and lead to people not getting the job done as well as they should within budget. So again, why do we want to plan the audit? 3 reasons. Number 1, obtain the sufficient appropriate evidence for the circumstances. Help keep the audit costs reasonable. Avoid misunderstandings with the client. We plan to do a site visit Thursday. We send an email to the client. We send a notice to the client. That is planning, as opposed to, well, let's just show up Thursday and hope the client is ready. So we have 8 steps here in 8.1 for planning an audit and designing the audit approach. Again, audit is a systematic approach. So the first thing we want to do in any audit is accept the client and perform initial audit planning. Second, understand the client's business and industry. Perform some preliminary analytical procedures. Set preliminary judgment of materiality and performance materiality. Identify significant risks due to fraud or error. Assess inherent risk. Understand internal control and assess control risk. Finalize the overall audit strategy and audit plan. And we're going to talk about this in this chapter as well as the balance of our course. So let's talk about planning. Several key terms that we need to be aware of. The first, acceptable audit risk. A measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an unmodified opinion has been issued. Acceptable audit risk, meaning we do an audit, do everything we're supposed to, issue the unmodified opinion, and then realize that there has been a mistake, that the financials were misstated. What's the possibility that, again, that's acceptable audit risk. The risk we're willing to take that basically we've missed something. Client business risk Is the risk that the entity doesn't achieve its objectives? Client business risk. What's the risk that a client may go out of business? What's the risk that a client's product may not be well received by the market? The risk of material misstatement is the risk that the financial statements contain a material misstatement due to fraud or error. The second objective, making client acceptance decisions and performing initial audit planning. So when we plan to do an audit, we have four things. So the first, we want to decide whether to accept a new client or continue serving an existing client. Now, accepting a new client usually will involve some sort of due diligence by the CPA firm. Do we want this client? How big are they? Are they clean? Do they look like they're going to cooperate? And if we feel those answers are in the affirmative, well, then maybe this is a client we want to accept. By the same token, we wish to continue. Ladies and gentlemen, because you have an audit client does not mean you need to keep them forever. Many an audit client is dropped because it's not effective and efficient for us to do the audit. It's no longer something we wish to be involved in. We no longer wish to do that source of business. Your client is in the not-for-profit arena. Your firm decides we're no longer doing not-for-profits, so we no longer will have the client. To avoid misunderstandings, the auditor will always obtain an understanding with the client about the terms of the engagement, typically called the engagement letter. And this is a signed contract between both parties, auditor and auditee, what we're doing, when we're going to do it, and of course, how much are we doing it for. In planning, the auditor will develop the overall strategy for the audit, including staffing, who's going to be on it, and do we need any specialists? Again, are we going to use general staff or are we going to use staff who have a specialty in the industry? So, looking at this a little more in depth, with client acceptance, some new client investigation. So, typically, there is a standard that says, really, we need to communicate with the predecessor auditor. So, if we're getting a brand new client and they're switching CPA firms, we have a responsibility to talk to the old auditor, or again, the predecessor auditor. The predecessor auditor. Due to confidentiality requirements, the client, your new client, has to consent to this. So you're not allowed to pick up the phone and call the old accountant, the old auditor. You need a written letter from your client indicating you may do so. And the purpose is to determine if the client lacks integrity or if there were disputes about accounting principles. So you go and you take on this great client and it's $100,000 and you find out that they're hard to work with from the old audit firm, that they did not like them. And it was not the firm, it wasn't the client, it was the accounting firm that dropped them. And what could happen? You may not take the client. You may feel, nope, it's not something we wish to pursue at this present time. Continuing clients, same thing every year. Does the client offer us a good steady income? Does the client offer us something we could be proud to be associated with? If the client is not somebody we want to be associated with, is it time to potentially drop them? So again, identify the client's reason for the audit. Why do you, the client, need an audit? What are the risk factors? Who needs this audit? Is it for your board, your owners, the bank, That's something we definitely would want to find out sooner rather than later. Obtain an understanding with the client. A clear understanding should exist between the auditor and client. And again, that is the engagement letter. Develop your overall strategy. This should be typically done with your senior and manager and partner where they have a preliminary audit strategy. Who's going to do what? How many weeks do we need for this client? What audit procedures are we going to perform for each assertion, for each level of account we wish to test? That is material. Selecting staff engagement for the engagement and evaluate the need for outside specialists. So again, let us imagine we're going to audit a pension plan. Well, we may wish to employ an outside specialist who knows defined benefit plans. Are the rates acceptable? Has the client properly recorded the liability? We're going to use their specialty to get us through this. The third objective, gain an understanding of the client's business and industry. It sounds silly, but we have to understand our client. Business they're in, the industry they're in. They're in the construction business. They're in the real estate business, the not-for-profit business. What is unique about these industries? Well, before you can do the audit, you better be able to answer that question. The auditor identifies and assesses the risks of material misstatement, whether due to fraud or error, based on an understanding of the entity and its environment, including the entity's internal control. An overview of the strategic approach to understanding the client's business and industry is illustrated in Figure 8.3. Understand their business. That may mean getting a book, going to a trade show that talks about these things, looking at an audit guide, looking at, again, the industry that they operate within, the external environment, business operations, and processes. Let's talk to our client. How do you run your accounting department? Who is your management? Who are your board of directors? What are the objectives and the strategies that you intend to use? How do you measure your performance? So let's talk about that. So again, why do we want to understand the client's business? Number one, risks associated with specific industries may affect our audit risk, our assessment of client business risk. If it is a tech company, maybe they have a heavier business risk than if they weren't. In certain industries, the risks are common to all clients in certain industries. So, for example, a big risk would be accounts receivable. Accounts receivable in a healthcare environment. That's a risk. We know that it's difficult sometimes to collect money from patients and insurance companies. Many industries have unique accounting requirements that the auditor must understand to evaluate whether the financials are in accordance with accounting standards. We're going to audit the town of New Rochelle, New York. The town of New Rochelle is a governmental client. So therefore, we need to know the GASB statements, governmental accounting standards. We're going to audit a construction company. We need to know percentage of completion and completed contract. Business operations and processes. The auditor should understand factors such as major sources of revenue, key customers and suppliers, sources of financing, do we have a mortgage, and information about related parties that may increase the client business risk. Tour the client facilities and operations. Touring the facilities is helpful in obtaining an understanding. Walk around the factory. Look at the different sites if they have 3 or 4 sites, because you want to make sure there really is a plant factory. You want to make sure you see the operations, you see what's going on there. Maybe it will strike something in you that could lead to an audit risk. Identify related parties. Because related party transactions may not be at arm's length, auditing standards require that related parties and related party transactions are disclosed in the financials. So if we know that somebody is doing business and they're on the board of directors and their sister is on the opposing company, that's fine. They're on the board, the sister is on the vendor that we're going to be using. We just need to disclose that in the financial statements. Management and governance. The auditor needs to assess management's philosophy and their operating style and the ability to identify and respond to risk. Governance includes how the company is run, is there a board of directors, and is there an audit committee. Code of ethics. Public companies must disclose whether they have adopted a code of ethics that applies to senior management. Auditors should have an understanding of the code of conduct and investigate any changes. Minutes of any meetings. Corporate minutes are the official record of the meetings of the board of directors. They include key authorizations and summaries of important topics being discussed. The auditor should read the minutes to identify matters relevant to the audit. These are all minutes, ladies and gentlemen. 100%. We do not sample. Read the minutes of the board of directors. Read the minutes of the audit committee. Read the minutes of the executive committee. That's important because you may discover something that's not in the books and records. Good example, lawsuits. There's a lawsuit that gets discussed at your particular meeting. That lawsuit is not booked in the actual books and records of your client. So if that's the case, maybe there does need to be an accrual. Reading the minutes will help that. Client objectives and strategies. The auditor should understand the client objectives related to the reliability of financial reporting, the effectiveness and efficiency of operations, compliance with laws and regulations. All 3 of these things do form the basis of internal controls. Measurement and performance, We also want to find out, how do our clients measure performance? What's a key performance indicator? Maybe the best way to give an analogy is like the GPA, so to speak. What's their GPA? What's an example? Market share. How much market share do I have? What are my sales per employee level? How many website visitors did I get? These are examples of key indicators that your client may use to benchmark how they're doing. The auditors have to say, well, if your client has set unreasonable objectives, especially when employees are incentivized to meet performance goals, there may be an incentive for aggressive accounting, which increases the risk of financial statement misstatement. Objective 8.4. Perform preliminary analytical procedures. Well, we said in our prior chapter that the auditors are required to perform preliminary analytical procedures as part of risk. The preliminary analytical and the post-analytical are very important. It is important to do them, again, at the beginning of an audit, to identify unusual trends and techniques which will enable us to perform better audit risk assessment. Post-analytical, final analytical, is to make sure we've covered everything. To make sure we have covered everything and that nothing still seems out of sorts or unexplained. And we do this with these analytical with some ratios with the industry standards. We also oftentimes will use common-sized financial statements to try to basically understand what are the percentages of each asset to the balance sheet or liabilities to the balance sheet. And some of you might recall some of these selected ratios from earlier accounting courses, but very powerful. Again, what do these things tell us? How do they enhance the audit? Short-term debt paying ability. Can we pay our bills as they become due? Liquidity. Are we able to collect cash? Can we meet our long-term debt obligations? Are we profitable? The fifth audit objective. Apply the concept of materiality to the audit. Materiality. The fourth step in audit planning is to make a preliminary judgment about materiality for the audit. Auditing standards define the concept of materiality as the magnitude of misstatements, individually or when aggregated with other misstatements, could reasonably be expected to influence the economic decision of users. The concept of materiality is a concept, not a number, a concept. And this concept says there are different mistakes in the financial. Okay, let's now combine the concept and add to it with some numbers. If you keep making so many mistakes, and they are big in dollars, it may expect that a person familiar with these financials could be influenced the wrong way. For the sake of argument, let us assume $1 million income statement. This income statement, basically, I tell you after we issue the audit opinion and you bought the stock, I made a mistake, again, $1 million income statement, of $100. That mistake would not force you to do anything because it is really immaterial. It's a mistake, but it's not material enough that you would go running to a bank and get your money back. If I was to tell you, though, on $1 million income statement, we made a $600,000 mistake. Now your head would start to pause, and you would be concerned. That's an important concept. And materiality is really the bloodline with the auditors, how we survive. Is it material? Is this going to sway the economic decision of the user? In terms of applying materiality, we have 5 steps. The first step is to set materiality for the financials as a whole. What number are we allowed to basically have misstatements as a client up until before it becomes material? Now again, materiality is a number determined by us, the auditors. Please note, that number is not shared with your clients. You may share it with the members of the audit committee if asked, but you don't want to let your client know the materiality. Why? Because then it creates an opportunity for them to kind of skew different things. Step 2 is to determine the performance materiality. That will enable you to plan what type of test you're going to do. What balance sheet and income statement accounts will we audit? Estimate the total misstatement in the segment. So again, if there are dollar mistakes, let's estimate it. Let's estimate the combined misstatement, and let's compare it with our preliminary or revised judgment about materiality. So again, is this material? Again, if we're off by a couple of pennies here and there, who cares? We can move on. The 6th objective. Make a preliminary judgment about what amounts to consider material. So again, some factors that affect preliminary materiality judgment, it's a relative rather than absolute concept, as we said. Please note, besides having quantitative, we may also have qualitative factors. You may decide that the materiality should be lower because you do want to do more testing. You're not comfortable with the client's internal controls. Likewise, can we raise materiality? Yes. However, if we wish to raise materiality, we want to make sure that there's a very good reason for doing it. Why? The higher the materiality, the less testing we have to do. Typically in the audit files, you will see a memorandum. This memorandum will tell the auditors, as part of their work papers, how they used materiality. So what they basically did is they did different percentages based on whether they were doing the income statement or the balance sheet. The 7th objective. Determine performance materiality during the planning. Now, this is important, folks. Materiality is determined at the planning stage, but can be revised. We are allowed to revise materiality if we find something and feel it needs to be changed. So typically, if you are auditing a non-issuer, it's called performance materiality. The PCAOB rule refers to it as tolerable misstatement. Performance materiality for an account, typically, most firms will go 50 to 75%. Auditors have 3 major difficulties when allocating materiality to the balance sheet. Certain accounts may have more misstatements than others, and we can have different materialities, folks, for different accounts. Both overstatements and understatements must be considered. And audit costs. Now, please note, we cannot simply not do a procedure because of audit costs. We have to do our professional responsibility. Over here is an example of a work paper from an audit firm where they have different accounts here on the left, how much they are, and the different performance materiality with explanations of how they computed it. Please note, different materialities for a lot of these things. Some are the same, but not all of them. The 8th audit objective. Use materiality to evaluate audit findings. Auditors document all misstatements that they find. They could be known or likely. Known, as it says, is what we found, what we know. We found a misstatement in prepaid expenses. Let's document it. There's also 2 types of a likely misstatement. 2 types, differences between management and the auditor's judgment about estimates of account balances, and projections of misstatements based on the auditor's test of a sample. So in other words, We found a mistake. Now we're going to project it to the entire population. That's a likely misstatement. If the likely misstatement is material above our performance and especially our planning, we may need to speak to the client and tell them they need to go back and adjust their records, that we're finding a lot of differences. And at this point in time, that concludes our discussion on Chapter 8. Please review this chapter again and then complete any and all assignments that might have been given to you. Again, all the best, and we'll see you online.